Yes, good evening class. Welcome for today's lecture. Today we are going to look at introduction to finance. So first of all, we need to understand what is finance. Finance, it is an art of managing your money or managing resources in order to reach to your goals. So finance, it is a broad term that refers to management of money, and it includes activities such as investing, borrowing, lending, budgeting, saving, and forecasting. So in finance, it is categorized into three. So one, we have personal finance, which is the management of an individual or family financial resources. And then we also have corporate finance, which is the management of companies' financial resources. So it can be, we have also business finance, which is the management of business financial resources. So this may include raising capital, making investment, and managing cash flow. So we also have public finance, which is the management of government's financial resources. So this may include raising taxes, spending money on public programs, and it can be borrowing money to finance deficits. So those are all some of the category of finance. So what is business finance? So we see that financial management, it is the backbone of any successful business. So if you want your business to be successful, you have to make sure you have good financial management system. So it is the art and science of planning, organizing, directing, and controlling financial resources to achieve its overall goal. So if you want to achieve your overall goals, you need to be having a stable or a strong, sound financial management. So here we are said business finance, it is the management of money and financial resources within a business. So it encompasses acquiring funds, allocating them effectively, and ensuring their optimal use. So business finance decision impacts all areas of business, from operation to marketing and investing. So let's look at some of the sources of finance. Let's look at some of the sources of finance. So one, we have bootstrapping. Bootstrapping, which is the fund, it involves funding a business venture using personal savings. So you can use the sweat equity, which is the founder's time and effort, or it can also be through asset sales. So we have debit financing, which here it involves borrowing money from various sources. So for example, we have bank loans. You go to the bank and you borrow money, and we have small business administration loans. So here it is the government backed loan with favorable terms of qualified small businesses. So we also have invoice factoring. So invoice factoring, it is the selling. Here you sell the outstanding invoices to a factory company for immediate cash. So here they often at a discount. And then we have equity finance, which involves the selling ownership shares in the company to investors. So here we also have a trade credit. So in this trade credit, it involves obtaining short-term financing from suppliers by delaying payments for goods or services. So let's look at some of the importance of business finance. One, it enables business to start, operate, and grow. So, and also it also ensures financial stability and maximizes risk. We also have, it helps the business to make informed investment decisions, and it also helps to contribute to maximizing shareholders' value, and it also helps in providing framework for financial planning. So those are some of the importance. And then let's look at the scope of business finance. So one, we have financial planning, forecasting, and budgeting. So this one, it involves setting financial goals, creating budgets, and forecasting future financial performance. So we have covers raising capital through debt and financing. So here, it involves making decisions about long-term investment, such as we have the new equipment or product line by evaluating their potential return on investment. So we also have involved, it deals with managing working capital and cash flow. So here it is we manage current assets and liability to ensure sufficient cash flow for smooth day-to-day operations. And then we also have addresses financial risk and management mitigation strategies. Also have investment analysis, which it's evaluating potential investment opportunities to maximize returns while minimizing risk. And then we also have dividend policy, which is deciding how much of the company profits to distribute to shareholders as dividends. So we have mergers and acquisition. So here we evaluate and manage the financial aspects of the mergers and then the acquisitions. So that is the scope of finance, of business finance. And then let's look at the objectives, some of the objectives of financial management. So one, we have maximizing shareholders' wealth. So this is often a primary objective for public traded companies. So here, the financial decisions should aim to increase value of the company's stock for its shareholders. So by doing this can, so if you increase the value of the company's stock for its shareholders, this can be achieved through strategies like increasing profitability, managing costs effectively, and making sound investment. So we also have ensuring solvency. A solvent company is one that can meet its financial obligation as they come due. So our financial management focuses on ensuring the company has sufficient cash flow and access to capital to pay its debts and avoid bankruptcy. So we also have achieving sustainable growth. So financial decisions should not just focus on a short-term gain, but rather it should be a sustainable growth involve increasing the company's value and profitability over the long term. So this can involve investing in research and development, expanding into new markets, or developing innovative products. Let's look at the impacts. What is the impact of business finance on stakeholders? So these stakeholders, they include, we have the shareholders, we have the creditors, we have the employees, and we have the customers. So how does business finance impact on the stakeholders? So let's look at how can the business finance impact on the shareholders. So these shareholders, a financial management, it aims to maximize a shareholder's wealth. So this can be through increasing dividend, stock buybacks, or simply by increasing the overall value of the company. And then we have the creditors. So financial stability is crucial for creditors who have loaned money to the company. So a sound financial management practices ensure the company can repay its debt on time and maintain a good credit rating. So we have also the employees. So the financial health of a company directly impacts job security, employees' benefits, and potential for wage increases. So the strong financial, you find that when we have strong financial management, it fosters a stable work environment and also allows for investment in employee training and development. So we also have the customers. A company's financial well-being can influence its ability to deliver quality products and services. It also allows them to invest in innovation and maintain competitive prices. So sound financial management, it allows the company to focus on customer satisfaction and long-term growth. So those are some of the impact on the stakeholders. So let's look at the role of financial management. The role of financial management in an organization. So we have one, goal setting and planning. So here, the financial managers establish financial goals aligned with the overall organizational strategy. So this might involve maximizing shareholders' wealth, achieving sustainable growth, and maintaining financial stability. So they also create financial plans like budgets, forecasts to allocate resources effectively, and this can allow us to track the progress towards established goals. So here you can be able to every time you can be able to trace how you're progressing in your organization, whether you're progressing towards your established goals. So we have acquisition and management of funds. So under here we have our financial managers oversee how the organization acquire funds through various sources. These sources, they may include, we have debit financing, which is loan, bonds, and then we have equity financing, which is issuing stock, or we have retained earnings. And then they also manage these funds effectively, ensuring optimal utilization and maximizing unnecessary expenses. And then we also have investment decisions. So financial managers evaluate potential investments in new equipment, a product line, or expansion opportunities. And then they also use tools like capital budgeting techniques, which is the net present value, internal rate of returns, to determine the best course of actions and maximize returns on investment. So we also have a risk management. The financial managers identify and assess various risks faced by the organization. So this may include, we have the financial risk. Under financial risk, which we have fluctuating interest rates. We have operational risk, which include disruption in supply chain, and then we have the market risk, which involve change in customers' preference. So we have they develop strategies to mitigate this risk and protect the organizational financial health. Then we also have financial analysis and reporting. So financial managers, they analyze financial data using tools like we have ratio analysis to assess the organizational financial performance, liquidity, solvency, and also we have profitability. So they also prepare financial statements. We have the income statement, we have the balance sheet, and also we have the financial statement, which is used to provide the stakeholders with a clear picture of the organizational financial health. So we have the decision making. By analyzing financial data, forecasts, and potential risk, financial managers provide valuable insights to inform strategies, decision making across the organization. So also they also recommend, their recommendations influence everything from resource allocation to pricing strategies to investment opportunities. So we also have control and compliance, which is the financial managers. They also implement internal controls to ensure proper financial reporting, which also help to maximize fraud, and also it also help in safeguarding our assets of the organization. And then we also have they also ensure the organizational adheres to relevant financial regulations and accounting standards. So we have profitability, maximizing shareholders' wealth. Financial decisions should aim to increase the value of the company. The value of the company. So you find that this objective of maximizing shareholders' wealth, it is a common objective for publicly traded companies. So these financial decisions, it should aim to increase the value of company stock for its shareholders. So this can be achieved through strategies like increasing profitability, managing cost effectively, and making sound investment. So we also have sustainable growth. This financial management shouldn't just focus on a short-term gains, but it should rather aim for long-term growth by increasing the company. This can be done by increasing the company's value and profitability over time. So this might involve investing in research and development, expanding into new markets, or developing innovative products. So number 2, we have solvency. So under solvency, we have ensuring a solvency. So a solvent company is one that can meet its financial obligations as they come due. So financial management focuses on ensuring the company has sufficient cash flow and access to capital to pay its debts and avoid bankruptcy. So we also have liquidity. Under liquidity, we have managing liquidity. So our liquidity refers to the company's ability to meet its short-term financial obligation. So the financial management ensures the company has enough cash readily available to cover its ongoing expenses and also avoid cash flow problems. So thank you. Let's meet up in our next lecture that we shall look at topic 2.